Hello everyone, I'm Nova Lui, the Head of Investor Advisory at RHB Bank. Welcome to our monthly Investment Insight podcast. February is a rosy month for the China and Greater China equity market. Hang Seng Tech Index up by 14% with both HSCEI and FTSE China A50 up by high single-digit return. This is also seen in other Asia's market including Taiwan, Korea and Malaysia. In the same time, all developed markets including Nasdaq, Europe and Japan are up by high single-digit return. Overall, February has been a good equity market month. The US equity market are driven by the continuous positivity in the tech sector, led by Nvidia posting revenue up by 265% on booming AI business. Overall, the Magnificent Seven continue to lead the US equity market. Despite now market is only expecting 4 rate cuts this year, which likely to happen on second half of 2024, which means any upside in the market now has priced in that there is no easing monetary policy in first half of 2024. This takes away at least one uncertainty in the market for the short term. The UK economy slipped into technical recession in the final quarter of last year, marking the second consecutive quarterly decline in the country's GDP. However, this has not impacted the UK equity market. In fact, on year-to-date basis, UK equity market represented by FTSE 100 trended higher, riding along with the rest of the global equity market. Moving to emerging market, China cut its key loan rate to support the property market, which means lesser burden for those property investors while injecting confidence to the investor that the Chinese government maintains its supportive measure for the sector. China's security regulator will ban security lending to investors who sell stocks on the same day of purchase and vow to crack down on illegal arbitrage using short selling. China authorities has announced a raft of measures to support share price after the market plunged to 5-year low. Curbing on short selling is a huge confidence injection to the Chinese equity market as part of the way to instill capital market confidence. Chinese equity market ended the month of February as the best performing country in Asia Pacific ex-Japan, with all China onshore and offshore market up by high single-digit to double-digit return in February. We continue to maintain a neutral view in China with slight positive bias. More catalysts should be expected to see from this market for a sustainable growth in the equity market. However, valuation in emerging market, especially China, is more attractive compared to the developed market. India as an emerging market has a capital market with the highest exposure in the financial sector according to the Nifty 50 index. Nevertheless, there has been a noticeable surge in the interest towards the technology sector within the country. India has ambitions to become the major chip hub on the line of the US, Taiwan and South Korea, and has been courting foreign firms to set up operations in the country. India has approved building 3 semiconductor plants with investment of more than 15 billion as the country aims to be the major chip hub. India has also narrowed the gap with China in MSCI Global Standard Index, which tracks emerging market stocks for investors. Index provider MSCI raised India's weightage in the index to an all-time high of 18.2%, which could lead to inflow of about 1.2 billion. In comparison, China's weightage in the index fell to 25.4% from 26.6% a year ago. With the increase in India's exposure in the MSCI index, the immediate effect is to see increase in fund flow from the passive ETF fund manager, while undoubtedly, active fund managers like mutual fund who uses Asia Pac ex-Japan as a benchmark may have to relook into the need to increase their exposure to this market. Finally, to Malaysia, ringgit weakened against US dollar and close to its level since Asian financial crisis in 1997 of 4.8850, making ringgit as its weakest in the past 26 years. Despite some recovery recently, local investors remain nervous on the current currency level. On the flip side, This may appear as an attractive entry point for foreign investors seeking to gain from equity and currency appreciation by investing into Malaysia's asset. Interestingly, as of end of February, marked the best 3 months rolling performance for KLCI in the past 3 years. We expect the positive momentum in the local equity market to continue due to the structural reforms announced by the government to achieve long-term sustainable economic growth. The Madani Economy Framework, the new Industrial Master Plan 2030, and the National Energy Transition Roadmap are positive for the economy, and the improvement in the bigger picture bodes well for corporate Malaysia's earning outlook. We continue to like global technology and income strategy. Since major global technology has been doing well, it is also a good opportunity to relook into your portfolio if there is any need to rebalance some of this exposure to other more value sectors or country while maintaining a portfolio exposure that is suitable for your investment appetite. Please engage our RHB Bank's relationship manager to know more about our latest fund focus and model portfolio. Thank you for tuning into our monthly investment podcast. We hope this monthly insight can help you to make a better informed investment decision. Please visit RHB Merge website to access our latest money chat and podcast series.